Stop whatever you are doing right now, put your phone down, and pay close attention to what I am about to share with you. A massive geopolitical escalation just hit the Middle East over the weekend. And if you ignore this development, you are going to walk into tomorrow's Monday market open completely blind. While the Western world was asleep on Saturday night, a highly strategic military action involving the United States, Israel, and Iran fundamentally rewrote the global macroeconomic baseline. The critical energy choke point that controls roughly 20% of the world's oil supply is now in active geopolitical play. Welcome to What Changes. My name is May, and today we are breaking down the exact financial fallout of this global crisis. Before we dive into the raw energy data, the shipping intelligence, and the institutional price projections, I want to invite you to join our Telegram channel and follow us on X to get real-time updates as this situation unfolds. You can find all the links listed below in the YouTube description, along with a special book recommendation that will completely change how you view global commodity markets. Now let us get into the hard data and uncover the perfect storm of physical scarcity and safe haven panic heading into the Asian market open. To truly understand the magnitude of what is about to happen, we first need to look at the baseline of the precious metals market before this weekend's events even occurred. On Friday, the commodity markets experienced a historic event during the COMEX first notice day. Approximately 23,500 contracts stood for physical delivery against a registered vault that was holding only 86 to 88 million ounces of deliverable silver. To put that into perspective, that represents a massive 75% drawdown from the peak levels we saw back in 2020. Even more alarming is the paper-to-physical ratio on the COMEX, which has now expanded to a dangerous 4-to-1 or even 5-to-1 imbalance. This means that every single ounce of registered, deliverable silver sitting in those vaults is simultaneously encumbered by at least 4 competing, legally binding paper claims. The exchange only survived Friday's deadline by invoking emergency delivery restriction mechanisms, effectively forcing cash settlements and off-market transfers just to avoid a very public and catastrophic default. Despite every margin hike, every exchange halt, and every coordinated media narrative attempting to call the bull market dead, silver still closed the month of February at $92.68, which was up an incredible 18.38% for the month. The entire financial system entered this weekend in the most fragile state in modern commodity history. And then, the Middle East situation exploded. At exactly 1:15 in the morning Eastern Time on Saturday, February 28th, the United States Central Command, operating in strict coordination with regional partner forces, initiated a comprehensive and strategic military action officially designated as Operation Epic Fury. From a pure market analysis and macroeconomic perspective, the sheer scope and the specific target selection of this military operation represent a total paradigm shift in how Middle Eastern geopolitical risk is priced into global markets. The operational objectives of this strike included the command and control infrastructure of the Islamic Revolutionary Guard Corps, integrated national air defense capabilities, military airfields, and advanced missile and drone launch sites. The single most destabilizing geopolitical outcome of this operation was the direct, targeted disruption of the highest levels of their centralized military command. This specific infrastructure is what maintains absolute executive authority over their armed forces, and its sudden degradation created an immediate command and control crisis. It created a massive power vacuum that institutional market algorithms simply have no historical model to price with any level of precision. Constitutional succession in Iran flows through the assembly of experts during a period of active national emergency, which is a political process that is inherently unpredictable. And as any seasoned financial analyst will tell you, markets price unpredictability with exactly one asset class: hard metal. In immediate response to the severe degradation of their centralized command infrastructure, Iranian forces initiated a series of aggressive retaliatory kinetic operations. These operations deliberately targeted military installations and strategic economic infrastructure across neighboring sovereign territories. Specifically, these retaliatory strikes hit locations in Qatar, the United Arab Emirates, Saudi Arabia, Kuwait, and Bahrain. The geographic dispersion of those retaliatory strikes is the critical variable for the financial markets right now. It has effectively transformed the entire Arabian Peninsula, which is the undeniable geographic heart of global energy production, into an active, highly volatile zone of geopolitical tension. This brings us directly to the single most critical maritime choke point on the planet, the Strait of Hormuz. Let me give you the raw mathematical data from the International Energy Agency and the US Energy Information Administration, because this is exactly where the macroeconomic transmission to precious metals becomes an unavoidable mathematical certainty. The Strait of Hormuz is the sole maritime connection between the Persian Gulf and the global oceans via the Gulf of Oman and the Arabian Sea. At its narrowest structural point, it spans a mere 29 nautical miles, which is roughly 54 kilometers. Within that heavily constrained geography, navigable shipping channels designed for deep draft supertankers are tightly restricted to 2-mile wide inbound and outbound lanes, which are separated by a fragile 2-mile buffer zone. Through those narrow lanes, an astonishing average of 20 to 20.5 million barrels of crude oil and condensate transit every single day. That monumental volume represents approximately 30% of all global seaborne oil trade and roughly 20% of total global petroleum liquids consumption. Furthermore, 70% of that vital energy flow is destined directly for the Asian powerhouses, Japan, South Korea, India, and China. On top of that, 20% of the entire world's liquefied natural gas trade, encompassing all major exports from Qatar and the United Arab Emirates, transits through this exact same geographic strait. Here is the severe structural inelasticity that officially turns this geopolitical event from a manageable regional disruption into a devastating global supply chain emergency. Alternative physical routing options exist, such as the East-West pipeline across Saudi Arabia and the Abu Dhabi crude oil pipeline, but they have a maximum, fully utilized operational capacity of just 4.2 million barrels per day combined. When you measure that against the 20 million barrels per day currently transiting the strait, the math becomes terrifying. It means that over 15 million barrels per day, alongside 20% of the global liquefied natural gas supply, has absolutely no alternative physical means of exiting the production region. There is no slow alternative, there is no expensive alternative, there is simply no alternative at all. Over the weekend, international shipping sources verified a VHF broadcast directly from the IRGC Navy, explicitly warning all commercial vessels that the strait is now closed to traffic. Following this, Qatar's Ministry of Transport issued immediate, urgent advisories to vessel operators to suspend all maritime navigation. Real-time global tanker tracking data has already confirmed that multiple heavily laden LNG tankers destined for Asian markets, including the Al Sala and the Reich, abruptly diverted their course, turning completely around and heading back west away from the strait. The market impact of this disruption was absolutely instantaneous. Maritime insurance premiums instantly spiked, global transit logistics collapsed into complete uncertainty, and the energy risk premium began aggressively repricing before Western markets even had a chance to open on Saturday morning. According to institutional modeling from Bloomberg NEF, crude oil, which settled at $72.48 per barrel as recently as Friday's close, is projected to gap up aggressively toward the $80 threshold the moment Monday's Asian session opens. Furthermore, revised institutional models are already projecting a rapid, sustained ascent toward $91 per barrel, or even higher, as the full geopolitical disruption premium is permanently embedded into front-month energy contracts. To put that $91 target into historical context, we have to look at the sectoral analysis published by Acquiris Securities, which examines 5 decades of conflict-driven commodity price shocks. Whenever geopolitical posturing transitions abruptly into active, sustained military engagement involving major oil producers or critical transit routes, the embedded risk premium expands exponentially, well before underlying market fundamentals can reassert themselves. We saw this during the 1973 Arab oil embargo, which drove crude from $3 to $12, representing a staggering 300% spike. We saw it again during the 1979 Iranian Revolution, which drove a 180% structural revaluation. And we saw it during the 1990 Gulf War, which drove a 140% surge from $17 to $41 per barrel. The current nightmare scenario combines targeted infrastructure destruction in Iran which independently produces approximately 4.8 million barrels per day, with an existential military threat to the 20 million barrel per day Hormuz choke point. This mathematically mirrors the most severe historical precedents on record. Now, as a financial analyst, let me explain exactly why an oil price spike from $72 to $91 per barrel acts as pure, unadulterated rocket fuel for gold and silver. Specifically, this is the exact macroeconomic transmission mechanism that the mainstream financial media will simply not explain to you clearly. Crude oil is the foundational input cost of the entire global economy. It literally dictates the baseline cost of manufacturing, agriculture, global transportation, and raw material extraction. A sudden sustained energy spike of this magnitude triggers immediate, highly inelastic inflationary pressures across every single global supply chain simultaneously. For the United States Federal Reserve, this black swan event creates an absolutely inescapable monetary policy dilemma. They are now forced to choose between two catastrophic outcomes. On one hand, they can choose to maintain highly restrictive interest rates to combat this new wave of supply-side inflation. However, doing so risks triggering a severe global economic contraction and a systemic banking crisis driven by massive unrealized bond losses. On the other hand, they can choose to pivot, injecting massive amounts of fiat liquidity into the system to protect the fragile financial architecture. Doing this, however, will relentlessly accelerate the debasement of the underlying fiat currency. This brings us to a critical inflection point. The recent nomination of Kevin Walsh as the incoming Federal Reserve Chair initially triggered a massive $1.5 trillion liquidation cascade across global asset classes in late January, simply because markets inherently feared an era of ultra-tight monetary policy. But facing a true, unmitigated supply-side energy shock of this scale, even the most hawkish central bank in the world finds itself mathematically constrained. They cannot print crude oil out of thin air. Both of their potential policy responses, whether it results in crushing economic stagnation or hyperliquidity, historically drive massive waves of institutional capital completely out of fiat-denominated bonds and directly into hard, tangible assets. The Federal Reserve's impossible dilemma is exactly gold and silver's generational opportunity. And right here is where we arrive at the great collision point. This global energy supply shock is not arriving in a healthy, robust, and well-supplied precious metals market. It is colliding directly into the most severely depleted COMEX vault system in modern recorded financial history. This convergence is the absolute defining factor of Monday morning's open. According to official COMEX depository statistics and rigorous institutional commodity analysis published by Live Mint and Disruption Banking, registered COMEX silver closed Friday between only 86 and 88 million ounces. Remember, registered silver is the only metal legally available to actually settle futures contracts. That figure is down an astonishing 75% from its 2020 peak of 346 million ounces. We are now down below 100 million ounces for the first time in modern recorded history. At the very same time, the open interest on the exchange is commanding active claims exceeding 350 million ounces. That means the paper claims represent more than 400% of the available deliverable physical supply. Every single solitary ounce of silver sitting in that vault is carrying the heavy, unbearable weight of 4 competing legal claims. Simultaneously, across the world, the Shanghai Futures Exchange silver inventories are sitting near decade lows of approximately 346 tons. That is down an extraordinary 89% from the 3,911-ton peak recorded back in January of 2021. Both the eastern and western physical silver markets are simultaneously running on dangerously, precariously thin liquidity buffers. This unprecedented physical depletion is the exact baseline into which a 20% global oil supply shock has just landed. When institutional teams run the actual Monday projection numbers based on this data, the models are showing absolutely explosive upward momentum. Gold, which was already exhibiting highly significant underlying strength by decisively breaking the $5,200 threshold and closing the spot market near $5,200, $178 on Friday, is now projected to gap up aggressively. CME futures, having already touched $5,296, are projected to immediately test heavy resistance clusters near $5,300, the very second the Asian markets open. The models show a rapid, violently upward trajectory toward $5,600 as the full severity of this geopolitical escalation and the resulting embedded energy inflation rapidly priced into forward models. This is not speculation. This is the baseline institutional consensus currently being cited across major platforms like Market Pulse and FX Empire. Silver is projected to demonstrate even higher volatility, largely due to its unique dual nature as both a safe haven monetary asset and an industrially irreplaceable material essential for the global green energy transition, having closed the turbulent month at $92.68. Institutional pricing models and expert technical analysts project that sustained momentum above the critical $90 resistance level will open an immediate, frictionless vacuum straight toward the $100 psychological threshold. Major institutions are already adjusting. Citigroup recently placed a formidable $100 silver target for the year 2026, but the timeline is rapidly compressing. Independent macroeconomic analysts, recently cited by golds.com, are actually projecting cycle peaks anywhere from $100 all the way to $180. This dramatic valuation is based entirely on the total structural breakdown of the paper suppression mechanism, compounded by the massive $12 Shanghai physical premium that we have been extensively documenting. That $12 premium is acting as a live, unrelenting vacuum, actively pulling whatever remaining Western supply still exists directly out of COMEX and LBMA vaults, and funneling it straight into the hands of Chinese industrial consumers. These Eastern buyers are incredibly price inelastic. They demand heavy physical bars, not empty paper promises. I want you to deeply understand the exact mechanics of the full short squeeze that will begin operating the moment the Asian session opens tomorrow. It unfolds in three distinct, devastating steps. First is the energy inflation vector, the very real functional threat to the Strait of Hormuz and the highly projected spike in Brent crude to $91 absolutely guarantees supply-side inflation globally, completely regardless of whatever policy the central banks attempt to implement. This reality forces massive waves of institutional capital completely out of the US dollar and directly into hard, tangible assets. This drives relentless, price-insensitive bids for physical gold and silver that simply will not stop at round psychological numbers. Second is the margin squeeze. During the extreme volatility in January and February, the CME Group was forced to raise COMEX gold margins from 6% to 8%. And silver margins from 11% to 15%. As gold and silver inevitably gap up on Monday in direct response to this Middle East escalation, the available capital buffers of institutional short sellers will instantly breach those newly elevated margin requirements. When this happens, brokers will systematically and automatically issue severe margin calls. This will trigger forced liquidations, driving massive market buy orders at prevailing market prices. Those panicked buy orders will relentlessly push prices even higher, instantly triggering the next sequential tier of margin calls. This creates a violent feedback loop that is entirely self-sustaining and self-accelerating. The third and final step is the physical delivery default threat, the ultimate backstop of any short thesis in any global commodity market. Heavily relies on the counterparty's ability to either quietly settle contracts in cash or actively source the physical metal for final delivery. With registered COMEX silver sitting dangerously below 88 million ounces against towering paper claims exceeding 350 million ounces, the math is brutally simple. There is absolutely not enough physical metal left in the entire Western financial system to honor all outstanding contracts if even a tiny fraction of the market simply refuses cash settlement. Chinese physical buyers are notoriously aggressive and price insensitive during major geopolitical crises. They have spent the last 6 years meticulously building massive strategic metal reserves. When they open for business on Monday morning, they will be facing two simultaneous, panic-inducing data inputs: the major Middle East military escalation and Friday's massive COMEX delivery surge. Their immediate response will be highly aggressive, thoroughly coordinated physical buying that will systematically pull whatever tiny trickle of physical supply remains completely out of Western vaults. The institutional short sellers operating on the COMEX are currently trapped in a completely unwinnable scenario. They are caught squarely between a massive global macroeconomic shift that is driving infinite fiat liquidity directly toward hard assets and a physical vault system that is functionally running on empty. There is absolutely no comfortable exit door left for them. Think about it logically. When severe geopolitical tensions actively threaten the global energy grid and 20% of the world's entire oil supply is trapped in active uncertainty, do you truly trust your wealth in digital paper assets? Do you trust a system that depends entirely on the stability of a fragile banking network and the honoring of synthetic paper contracts, the exact same paper contracts we just watched, the COMEX, desperately struggle to fulfill on Friday? Or do you seek refuge in tangible, physical metal that you hold in your hand, an asset that carries absolutely zero counterparty risk, and an asset that China is simultaneously willingly paying a massive $12 per ounce premium to actively acquire? So here is the absolute final verdict as we look at the data on this Sunday morning. We are standing exactly 48 hours after Friday's historic COMEX drain and just 24 hours before the opening bell of the Asian market. The global energy supply chain is officially fractured at its absolute most critical maritime choke point. 20 million barrels of crude oil per day are currently trapped in active uncertainty, with a meager 4.2 million barrels per day of bypass capacity available to alleviate the pressure. Brent crude is aggressively projected to gap from $72 straight toward $91 per barrel within mere hours of Monday's Asian market open. That massive, unavoidable energy inflation shock will instantly force a catastrophic monetary policy dilemma squarely onto the Federal Reserve. Historically, this exact macroeconomic setup drives terrified institutional capital into precisely one safe harbor: hard, tangible assets. And right now, those massive institutional demands for hard assets are being directed at a COMEX vault system that is sitting at a devastating 75% drawdown from its recent peak. The system is buckling, with 4 competing paper claims desperately fighting for every single registered ounce remaining in the vault. The data models are clear. Gold is aggressively targeting the $5,300 mark, with rapid upward momentum moving toward $5,600. Silver is staring directly down the barrel of the $100 threshold, launching from its Friday close of $92.68. Meanwhile, the massive Shanghai physical premium is still sitting at $12, happily paying a massive premium for the physical metal that New York exchanges are trying to price with cheap paper at significantly less. The Western vaults are nearly empty. The global arbitrage gap is blown wide open and remains structurally unclosable. The ultimate geopolitical risk premium just forcefully entered the commodity market with unprecedented violence. And the Monday morning opening bell is just hours away. I want to know exactly what you are thinking as we head into this historic week. What is your exact tactical move going into the Asian market open tomorrow morning? Are you firmly holding physical metal straight through the weekend, carefully watching for that Monday gap-up confirmation? Are you closely monitoring the Shanghai physical premium and the critical gold $5,300 threshold as your definitive trading signal? Or are you sitting cautiously in cash, waiting to see if the massive institutional trading algorithms attempt one final, desperate shakeout of retail traders before the historic run truly accelerates? Your strategy matters, and sharing it helps us all analyze the landscape better. Be sure to join our Telegram channel and follow us on X using the links in the description below so we can keep the conversation going in real time. And absolutely do not forget to check out the book recommendation linked below to further your macroeconomic education. Thank you for joining me here on What Changes. I am May, and I will see you all in the next update.